Hello there, Maverick Traders. It is March 18th through the 22nd. We just wrapped up with our March options expiration, and we will be doing the accounting on Monday, payouts on Tuesday, and level advancements on Wednesday. But March is closed, so we must look ahead to the next week. In this session, we're going to be covering what happened this week. We'll look at the news. We'll look at the reaction to the news. Then we always like to take a fresh look. Did we get a score change? And we'll go down all the sectors one by one and find out what's the strongest, what is the weakest. And then we're going to pick some of those sectors and find the best trade setups in those sectors.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the Apply button in the video description. Let's get ready for the week.
Before we jump into the markets, we are in March, and we all know, yes, it's spring, but it's also March Madness. Now look, we do two sports events here at Maverick with our traders. We do fantasy football every single year, and we do March Madness. If you don't even know what this is or you don't care, okay, just ignore what I'm about to say for the next 30 seconds. Check out, I'll let you know when to check back in. If this is something you like, then let's do it here. The 9th annual. Now look, I am not a college basketball fan at all. I'm not really even an NBA fan. But I truly believe that March Madness is the single greatest event in all of sports. It's amazing. 64 teams. They just put them in a bracket, and if you lose, you go home. And if you win, you are the champion. It is awesome. And the first couple rounds are always great with the upsets. So if you want to join us, I will be sending out an email over the weekend for you to join our pool. We will have first, second, and third ranked prizes. Usually we do like $250, $300 for the first prize. So if you want to join in, you're going to need to have an ESPN account because we will be doing this through the ESPN March Madness app. So download the app, get yourself a username and password, and let's have some fun with March Madness. All right, well, let's go on to the markets here. So what happened in the markets this week? Well, we ended up on a down note, and it was pretty much a sideways week for most stocks, but a down week for things like small cap and tech. So we did have a down week, and we had some negative inflation reports. I'm going to talk about that in just a second. Those inflation reports pushed the 10-year bond up to 4.3. We've been talking about as long as bond yields stay low, this market can keep rallying. However, I said this 2 weeks ago, if bond yields go up too much, it's going to put pressure on the market, and that's literally what we saw this week. We did see oil break out of resistance. Look at that nice breakout, trading above 80 for the first time in like 6 months. So we've liked energy the last couple of weeks, and it is absolutely our favorite sector at this point. Let's talk about these inflation reports because we got two inflation reports. The first one, we got the CPI. And if you can take a look at those numbers, 0.4% for the core, slightly higher. So this was a higher number, but the market took it pretty well. The market didn't freak out. And then we got the PPI on Thursday, and the market, this was much, much hotter than the CPI. So the CPI was a little hot. This one was red hot. And the market really took this pretty well too, but over the week, it just was enough of a drag to pull us down to where the market really couldn't get anything going as bond yields kept going higher. Now, I want to point out retail sales because retail sales were disappointing as well. This is the exact opposite of what we've had over the past 5 months. Over the past 5 months, we've had weakening inflation numbers and strengthening economic numbers. Like retail sales was beating pretty much every month for the last couple of months. This is the opposite. This is what the market doesn't want to see. Rising inflation and weakening economic numbers. Like I said, there's a reason to be defensive. We talked about it last week. We'll talk about it again. But there's definitely some reasons here to be defensive. Let's take a look at the actual performance for the week. We had the Dow and S&P basically flat. So if you take a look at just a small sliver, it wasn't a bad week. It was more of just a base. You take a look underneath a little bit more and you can see NASDAQ, tech stocks, small cap stocks, they got hit pretty good. And you can see oil with that nice 4% breakout. That's why we do like the energy sector here quite a bit. Let's go into the charts. Now, I'm going to show you, this is kind of a story of two markets. If you were to look at the S&P 500, you would say, oh, you know what? This is still a base. There's still nothing to be worried about. We're still trading a tiny bit above the 20, not much, but a tiny bit above the 20. So for me, if I was giving my scores of, is it above the 50? Yes. Is it above the 20? Maybe like a half point. And are both lines sloping higher? The answer is yes. So it's pretty clear the S&P is still at like a 2.5. But if I come over here to the NASDAQ, all of a sudden, oh, this doesn't look nearly as good. So if I had to answer those questions again, is it above the 20? No, it's below the 20. That's a -1. Is it above the 50? Yes. So that cancels it out. Are both lines going higher? And if I take a look here, no, that 20 period moving average is starting to flatten out. All of a sudden, this goes down to like a 1.5. So I've got a 2.5 on the SPY. I got a 1.5 on the Qs. And if you take a look at the Russell, you can see we're here at like a 1.5 as well on the Russell. So there is reason to have a little bit of, again, not fear, but just understand it makes more sense to get defensive. We talked about it last week. We said, hey, we're starting to see some things. Let's get a little bit more defensive. This is simply repeating that, telling us to get a little bit more defensive. If we take a look at the heat map, you can see there were some areas of strength. The large cap tech ended up holding up really well, and that's why you see the headline numbers of the S&P were up, because this is a huge chunk. And then take a look at large cap banks. Take a look at energy, how strong it was. These are masking some of the weakness we're seeing underneath, especially in some sectors. And we're going to go through all the sectors, score them from top to bottom, and we've seen some real deterioration in some of those sectors. So this week, we have to be realistic. First off, the week after monthly options expiration tend to be slightly negative. So looking back on all the weeks after monthly options expiration, there is a little bit of a negative bias. So we have that going. We also have Friday's week close, also probably going to carry over. We also have the fact that we've had, a huge rally over the past 5 months. We could definitely see some profit taking. I left this next one up. Later stages of a bullish move. Don't be scared. Enjoy it while it lasts. I talked about this last week. I talked about, hey, let's get more defensive, but let's not bail. Let's not go short. Understand that there still could be a few weeks left. We don't know what's left. There's more evidence to tell us that this party, at least for the short term, is more likely over. But that doesn't mean the markets crash. And that's what everyone always thinks. Everyone thinks it's a binary of the market's either going up or it's crashing. Do you know how many times it's not doing either of those things? Probably the majority of it. I think we're going to get, again, slight pullbacks from here, some basing, some consolidation, but probably more weak than strong. I'm not scared of the market having a big 5 to 10% crash. That's just not on my radar. Of course, it could always happen. It's just not on my radar. But let's talk about those bonds, because those bonds are absolutely key. Take a look at this bond market chart. You can see that if we break above 4.3%, it's a breakout, and this market will not react positively on that, because that means that there's less likelihood that they get a rate cut this year, and the market is pricing in a couple rate cuts this year. And if those bond yields go higher, it means that those are being removed. Stocks are going to sell off because of it. We also have the Fed meeting on Wednesday. So we will literally be hearing from the Fed about exactly that. Are rate cuts still on the table? Personally, I said this in January. I said the market is pricing in 3 rate cuts. I don't see how the market is looking at this. I just don't see it because inflation is still stubbornly high, and we've had the confirmation of that the last 2 months. I just don't see how the Fed can come out as anything other than hawkish here. We'll have to wait and see. But again, if they come out hawkish, it's going to tell the market, okay, you've mispriced things and we'll reprice things lower. Other than that, there's really nothing on the schedule to be concerned about. So that is on Wednesday, 2 p.m. Eastern Time. Expect there to be some big movements in the market on that day. We have been at a +3 for a very, very, very long time. I want to say it was either like the first week of December or like maybe the second week of December. I can't remember when. We've been at a +3 the whole time. It's time to downgrade it. Time to downgrade to a +2. As I said, the S&P still looks okay, maybe like a 2.5. The NASDAQ and the Russell look like a 1.5. So we're just going to make this down to a 2. All this is saying is be less bullish. It's not saying be bearish. It's just saying be less bullish. Now we're going to take a look at the sectors, and the sectors are going to tell us where the strength and weakness is. And we've got a real nice divergence this week. I think there's going to be some great trade setups based on sectors. Many people are unfamiliar with exactly what proprietary trading is. Prop trading is when a private firm hires traders like you to trade with their capital. Those traders are paid a percentage of the profits that they generate for the firm. Profitable traders are awarded higher and higher levels of capital to trade so they can take bigger positions and make more money. We've been in business for over 25 years, and we're one of the oldest prop firms based in the USA. If you would like to look into being a trader for Maverick, look in the video description below and click on the trader position to apply. Last week, the strongest sector was the energy sector. I said last week it was my favorite sector, and it did really well. Materials was the second best sector. So these two, raw materials, remember that PPI said that raw material prices are going higher. Very bullish for these two sectors. Other than that, it was a down week. Imagine if we took out the materials and energy stocks and we took out some of the large cap tech stocks like Microsoft and Apple that actually had up weeks. It would have been a much more negative week. And you can see where the pain was felt. Real estate, those rising bond yields are definitely not helping real estate, and consumer and tech. I talked about how bad consumer was looking. Consumer had a bad week. I'm looking to continue to stay short in consumer and adding in tech as well. But let's go ahead and score them all one by one so we can really nail down where the strength and weakness is. Here is the utility sector. Okay, the utility sector, take a look at it. It ran up, made a new high, and look at this pullback. That's a very, very moderate pullback. That doesn't scare me at all. This is going to stay at a +2. Communication services. Okay, so at a certain point, stocks go from a high base where they run up and run up and run up, and then they base. And typically they base until things like the 20-day moving average comes up and puts some pressure on them. And then they break out and run. And then sometimes they don't run and they just sit there and sit there and sit there. And at a certain point, it's no longer a base of gaining momentum. It's tapped out. It's tapped out here. Moving averages are starting to flatten. Look, we still have to go with our scoring system, but the moving averages are flattened. It's at the 20 and it's above the 50. So that earns a +1. So that is a downgrade from a +2 from last week. Healthcare had a pretty significant pullback. Came up to a new high. We pull back. We're trading between the 20 and 50 and they're flat. This is pretty much as close to a 0 as you could possibly get. Now that doesn't mean it's going to go sideways. This thing still has a momentum. But right now, there is no clear trend on real estate. We come over here to the healthcare sector. Last week, it was at a +2. We have to downgrade this to a +1. We broke below that 20-day moving average. And you can see we are just hanging out here. It's not bearish, but it's just not as bullish here. Probably going to go more sideways than anything. One of the sectors that I've really been championing is the industrial sector. And looky here. This is a base. Now look, it might turn into what communication services. It might turn into a pullback. But as of right now, this is a great looking chart. This to me, I don't have any fear of this sector being a really nasty crashing sector. It could follow the market down, but it's definitely outperforming here. It earns and keeps its +3. And then look at what financials did. Someone forgot to tell financials that you weren't supposed to go up last week. They made a new high. They made a new high, pulled back, and had a little decent candle on Friday. So financials also remains at a +3. It looked really good last week. We downgraded consumer last week from a +3 to a +2, and we're downgrading it this week as well because we now have gone below the 20. We are above the 50, and we're between those two, and they're flat. This earns a 0. So this is one of the weaker sectors out there at a 0. Going to tech. Tech was high basing. But you can see now we're starting to trade below moving averages, holding that. We have to say that tech is no longer as strong as it was. It gets downgraded from a +2 to a +1. Finishing up with materials and energy. Check out materials. It was a +3 last week. It's a +3 this week. This looks absolutely fantastic. Energy was a +2 last week. We get to upgrade it to a +3. We have seen this moving average start to steepen. That's what we were waiting for. It has happened. What a fantastic run. Yes, we have a little bit of a shooting star candle on Friday. Wouldn't be surprised at all to get maybe a little pullback after this monster run. But this is showing you this is currently where the money is going. Last week, we had a whole bunch of stuff stacked at +2 and +3. We had 5 sectors downgraded this week. So real estate and consumer are the weakest sectors at a 0. Comm services, tech, and healthcare downgraded to a +1. Only one sector got an upgrade this week. So energy, financials, industrials, and materials, they look great. They're holding in really nice. They're either going up or holding in really nice. So there's no question where you go hunt for trades. Where do you go look for longs, and where do you go for shorts? Now, I'm going to spend more time on the short side this week. I don't want anyone to jump to the conclusion that it's a green light to go bearish. I'm just doing that because we've been so bullish and introducing so many bullish trades that in case that you are a little bit too far on the bull side, I wanted to talk about some potential trades to add on the bearish side to bring your portfolio back down in overall net delta. So let's go ahead and take a look at some of those trades. Again, I'm going to be focusing on the weak sectors, looking for more short setups and long. Starting off in the real estate sector, this is the sector that was downgraded to a 0. Kimco Realty. All right, Kimco Realty, you can see here, was in a long base. Long base here. We broke down on Thursday. So Thursday would have been a great entry point, a fantastic entry point. Well, it's not Thursday anymore. It is the weekend. You can see we gapped down and had a run. There should be some pretty decent resistance right at this 1920 area. If we're lucky, we're going to get a nice little run or a big bounce on Monday. I doubt that's going to happen. But for me, I like this one short. And the big question is, where are you looking for it? I still think it's too early to be aggressively short. So I think you want to be moderately short. I'm looking at the 18-19 bear put spread. So you can see it's up at the higher end of that range. So this is going to be directional. If there were 50-cent strikes, I would definitely be doing the 1850, 1950, but there isn't. So the only pick here is to do the 19 down to the 18, but we're going out for an entire month, giving it plenty of time to weaken down to that level. I like the fact that it is a monthly, giving us a full month for this weakness to work through the real estate sector. Next, on to comm services, was also downgraded. I'm looking at Roblox. Now, the thing I'm always looking for is stocks that underperformed when the market was going up. Remember, the market was going up in February. It was going up in March. It didn't. It had a little run here off of earnings, but then it plunged right back down. This is looking really dicey here, and you can see there is a bunch of support here in this 38.50, 39.50 area. Got a lot of momentum to the downside. I think it's just a matter of time for this one to break. This is where I like to do these trades, but you do have to have enough time on them. If you're going to be directional, I like this one, the March 28th, so 2 weeks, the 38.40. So this is what you're looking at right here. This is your area. You think it's going to go below 38 within 2 weeks. I like that call. If it breaks that support, it's definitely going to blow through there. However, if you say, hey, you know what? I want to be a little bit less bearish. A 39.40 is you're just playing it here. You just need it below 39. That is a really, really what we call chicken bear. And that's perfectly fine if that's what you want to do here. There's no reason to get aggressively bearish on anything here. We're not there yet as far as a market score. So all the trades you do bearish need to be shorter term. They need to be closer to at the money. You really can't be asking for things to make huge moves here. It's just not where we are in the market. Consumer is my favorite short. Last week we took a short in Tesla and it was a max gain. It was a great trade. Here we have Nordstrom, JWN. Take a look at this beautiful little bear rally. Got a nice bear rally. From the $17, runs all the way up to $18.30, comes back down. Friday's candle looks atrocious, closing on the low. You see, we got support here. This should break down below support. As I said earlier, you just can't be super bearish. The most bearish I think you can be is down to 16. So 16 is going to be down here. I think that's even a little bit aggressive. You could do the 16.18. I think the 17.18 is even a wimpier play, and that is actually going to be some positive theta. So it just needs to hang around in here. As long as it hangs around in there, it's going to be a profitable trade in this weak sector of the consumer. Next, on to technology. Technology downgraded from a +2 to a +1. This one looks like an absolute disaster. These were the stocks that were very difficult for me to trade as a newer trader. If someone showed me a stock, especially in the long side, if someone showed me a stock that was at 50 and it had already run up to 80, I would say there's no way I can buy that because I'm not going to be the idiot that buys a stock that was 50 a month ago and is 80 now. I'm not going to be that idiot because I looked at everyone who was buying that stock at 80 as idiots. Now, we've all seen it before. Those go to 90, those go to 100, those go to 150. Yeah, eventually they do crash. But it's very typical. This is just simply on the other side. A stock that was at $232, it's almost been cut in half. A lot of people say, ooh, we've already missed this one. No, look, the market has been going up in March. Look at this. Plunge, couple day base, plunge, couple day base. This thing is losing lots and lots of market value. I like this one for a short. This is one of my favorite shorts out there. But you can't go crazy. You can't be like, oh, I'm going to, buy long puts. We're not there yet. The most directional I'm going to get is the 150. The 150, 155. This one is more aggressive. You do need a move and a decent size move. If you don't want to do that, then you can always do something closer to at the money, the 155, 160. That is going to be a theta positive trade with a little bit of negative delta. Perfectly, perfectly fine if that's the trade you want to do. Hopefully you can see nothing I'm showing you is crazy, crazy bearish. Now look, the charts are crazy bearish, but none of the options trades. We're still looking for very moderate size moves on anything bearish and staying fairly short term because this is still a bullish market overall. It's just showing some short-term weakness at the moment. And then, of course, I do have to show you one last trade in my favorite sector. Energy looks fantastic. It just looks great. I came across this one. I've never played this one before, ERF. And I widened this out so you could see that there is a long bit of resistance here that just got taken out. Just got taken out. I don't see any reason. We popped here after an earnings report up to 19. I don't see any reason we don't get to that 19. Of course, we have no idea what's going to happen. But when you take a look at charting, the charting says this one has a good shot at getting to that 19. So that's the target. This only has monthly options, so you're going to have to go out to the April 19th, the 18-19 bull call spread. I don't think you can go much past 19. This isn't really it's a pretty decent mover. But I think that's all you can ask for it here. Even if the sector is really heating up, 18-19 is where you want to be. Right, if there's any trades you want to share with the rest of the group, you guys know where to go. Log on to the website. I've seen some good activity in the forum lately. Jump onto the forum, ask some questions, answer some questions, meet some other traders. We always love to see our traders working together to make everyone more money. Let's wrap this up. I had this last week. I'm going to stay with this theme, start to get a bit defensive. I did not say start to get bearish. Absolutely not. We are not having any signals yet on a chart to get bearish. Just wait. We know it happens. We waited for that in 2022. We had a nice 2022 when the market had a couple really nice bear market moves. I think it had 3 bear market moves in that year. Remember, bear market moves, they're short, they're sharp, and they typically last, a month or two. I know that every so often we get a really prolonged bear market. It definitely hasn't happened lately. We saw them in the 2000s and the early 2010s, but it's been pretty bullish here for the last little bit. Most of these moves are fairly short term, especially if the economy is still growing. The economy is still growing, so bearish moves tend to be short and sharp. Understand that. That's where we are. As long as the economy is growing, expect them to stay short and sharp. Once we get a bearish signal, we'll go ahead and get more short. And then when that's over, we'll go back to a moderately long outlook. But it's not ready to get short yet. Everyone have a great weekend. Thank you so much for joining me, and take care, everyone. Goodbye.